Hi, this is Simon Singer. I'm the founder of the Center for Tax Strategies and Resources. And today we have a very significant treat for you. We've got two presenters, tax attorney Joe Strazzeri and Shelley Lightfoot. Their offices are down in San Diego. They've got a presence in Orange County, Los Angeles, and Las Vegas. And Shelley is the Chief Marketing and Executive Director of the Southern California Institute, which is an entity that Joe and his partner Steve created about 15 years ago. That's a think tank for attorneys and accountants to help them better understand not just the law and the strategies, but the process and the language that goes along with it. Joe's a very interesting, quote, tax attorney because he had a previous life. And the previous life was that he was actually a businessman. He was a general contractor, so he brings a unique understanding of business people's problems and issues and the family dynamics that go on with any family-owned business. Exceptionally talented at fixing messes and expanding people's thought process, getting families back together, and then being able to implement some plans. Their firm is also very user-friendly to people in our industry, albeit assets under management or pension planning or insurance professionals, etc. So at this time, I'd like to introduce Shelley Lightfoot and Joe Strazzeri. Joe, take it away.
Good morning, Simon. Shelley, thanks for doing this together.
Yeah.
It's odd to not be next to Shelley. We had those couple of months where we had to see each other this way. We've been back together now for, I don't know, 4 or 6 weeks. So to be apart like this, Shelley, seems weird.
Yeah, I know. I know. We just roll with the flow, though, right?
Sounds good. So today, our conversation is to be business succession about the 5 transition goals. Now, remember, as we look at these 5 transition goals and everything else here, it is twofold. One, it's how you're going to use this to actually help your business owner clients, how you're going to use it to help your business owner clients accomplish what they need to accomplish. But secondly, how do you help attract that business owner client? How do you help attract that business owner client? And how do you help the collaborative advisors around you have language to get that client to you? So Shelley, what do we got next? Oh, why don't you do this?
So just really briefly, Simon touched on it a little bit. We have the Southern California Institute. These are the 3 companies that we have here that Joe owns with his partner, and then coupled with other partners as well. Southern California Institute is what I spend the majority of my time doing. That's an educational platform, like Simon said, thought leadership, creating a community of advisors that can come together and access resources, and whether that be introductions, programs, events, digital content that's on our academy, etc. The Strazzeri Mancini is where everything started. So that's Joe Strazzeri that we have here with us today, and his partner Steve Mancini. That's the law firm. The law firm, started out as an estate planning law firm, and we still do basic estate planning. We call that our protecting promises, so your trusts, wills, and so forth. But we also are really best known for resolving messes. So, those complicated cases, your business owners and your families that have a lot going on, and they have a lot of complexity. They probably have several advisors involved. They probably own a couple of businesses. They probably have a lot of real estate, and they're needing an integrated plan. They probably need some business succession. And as you all know, working with families, there's often a little bit of conflict involved. So the family governance counseling comes into play there as well. So that's a really big part of our firm and what we do. The Founders Group is what's most closely related to what we're talking about today. Founders Group works with business owners on succession planning or transition planning and helping that owner through a process to increase that value and then determine what to do with it. And we're going to talk a lot more about that, so I'll just move on. This you just saw on the previous slide for business owners is about leading them through all the phases of transition. So we're hoping to get started a little bit earlier Maybe, it'd be awesome if we could get 3 to 5 years. Sometimes they come to us in the middle of the sale, and so, we need to back up a little bit and try and help them through some tax planning and that type of thing. But leading business owners through all phases, the goal is to increase their clarity, increase their cash flow, expand their choices, and at the end, they may decide that they want to keep it. So, if they decide to transition, they may want to determine they can keep part of it or, sell all of it. There's all different options as far as exits are concerned.
Shelley?
Yes.
Shelley, let me ask you a question. Have you ever run into a family with more than one individual in the family? Have you ever run into a family where there wasn't something like a brother-in-law who owned shares in the business because of his marriage to the sister who also wasn't involved in the business, and they don't understand why the compensation that he receives as an employee is not commensurate with the CEO, who's the alpha dog brother who runs everything, not understanding that he never shows up and nothing ever comes out of his office except complaints. Have you ever run into a family-owned business that didn't have that kind of stuff?
I don't think so. Joe, have you run into one?
At the end of the day, most family-owned businesses have some level of controversy, whether it's passive-aggressive, overt, or somebody's being quiet in the corner about it. And the problem is that it will rear its ugly head when somebody has a health event. So dealing with it early is very important. And Simon, you're talking about the things that happen all the time. Is it that I get my pay because of my last name or because of my relationship, or is it because of what I accomplish? And helping the owners think through that is very important. I was with a couple last night who just had a very, very large sale, and he was talking about what his children would receive because he did great planning and whether that was going to ruin them or make them better. But also his son-in-law that still works for the company. This gentleman is still there for one more year, as in most deals. And he said, Joe, I was forced to promote my son-in-law, and now I know he will lose his job within the next year. I know he will lose his job within the next year because he was promoted to a place he can't handle.
Wow.
So it's not uncommon. And when you sell it, there's problems or not. But Shelley, please, next slide. So most business owners appear to us, most clients appear to us, like they do to all of you, in the decision. They are now facing, do I sell? Do I transition? What do I do? I've got to do it now. And they're feeling the pressure of something soon. They've either had a recent health event, they're tired, the market has changed, the business has gone through a fluctuation, they've received an unsolicited offer, whatever that is. And they're now faced with a decision. And their decision is, how do I sell? Do I save in taxes? Do I not?
How do I know if it's a good offer? Who should be involved? Who should get parts of it? There's tons of questions there.
So we talk to business owners all the time, like you all will, and we say, look, you're faced with a decision. Do you keep and grow your business, or do you do a transition to your family, your employees / executives, or to an outside third party, and do you cash in all your chips, or do you cash in some of your chips? And they lean back and they say, no, I just want to do X. We say, great. That is an option. Here are the other options in front of you, one of which is still keep and grow. They're faced then with, how do I make that decision? No matter which decision they're going to make, the first steps are the same. There is a take a look at what your current value is subjectively from what you know, a recasted EBITDA times a multiple based on what you think your company stands according to other companies, where it does. And then an outside objective valuation, finding risk areas that if you took care of, your company would sell for more. And then do you attack that or not? We often have the conversation. Look, when you sell the business, you're going to receive less than you thought because buyer's counsel's job is to find areas that you suck in. And they get paid really well to do that. And when they find the risk areas, concentrated vendors, concentrated customers, too much control by the owner, financials that are not what they appear to be, market shifts that are not what they appear to be, improper pricing, whatever it is, they're going to reduce what they offered. So the first reduction, what you're going to get for the company, is because of that risk assessment, usually done by a valuation person. Number two, it's going to be reduced by the cost of sale. How much does it cost you to sell? Let's say 5% plus a bunch of things. The third way it's going to reduce is by taxes, which is the largest reduction, which is going to be somewhere between 30-40% of the cost of the sale of the gain inside of it, and most people have a very low basis. And then you're going to have a bucket of money that you're going to need to invest. The problem is, right now you're receiving X plus Y in benefits is Z. If you go through this sale and have all those nicks done to you, you're going to receive about half to 3/4 X plus no Y, yet alone Z. So you're going to get less cash flow by selling the business unless you attack those things. So we should talk about what gets done first. So we'll talk about 5 stages of business. I'm sorry, Shelley.
No, go ahead.
We'll talk about the 5 stages of business, 5 transition goals, a process to get there, and we'll review that. Remember, this language is to help business owners in what they need, and also to help, number 2, attract them to you through their advisor or not. This very direct slide exists on the Founders Group website, which is at foundersgroup.biz. It's called the 5 stages of business. It is deceptively simple. It is intended, and actually does, appeal to the business owner's spouse, the alpha in the business, middle-level management, and employees all at the same time. What it suggests is, hey, owner, be involved only as much as you want, but become worth more. It says to the spouse, would you like this person at home more? Would you like more attention or not? It says to the alpha, the owner is willing to get out of the way and listen to you more, whether that's an alpha child or an alpha business person in the business. It says to middle-level management, there's room to grow. And it says to the team, we're stable and there's room to grow. So you don't have to talk about this slide a lot. You just have to show this image. And then whoever the constituency is says, I'm at stage, or we're at stage, whatever that is, stage 3, and we'd like to go to stage 2. So I often ask owners, where are you today? And they lie. They give themselves more credit. Then you ask them a few questions. They say, nah, I slipped back. I don't know how to raise in my stage. You say, well, we have people that do.
So I think that, part of the key here is what we're suggesting. It's a great conversation starter with your business owners to say, hey, take a look at this. How involved are you in the company? Which of these things are you doing? And as you move through the stages of business, obviously the Valhalla is to be at stage 5. That's where you're going to get the most value out of your business if the owner is maybe not even involved anymore, or is only as involved as they want to be. And so this is about causing alignment between the leadership and the owner, and letting the owner get the heck out of their own way. So this is just a conversation starter to say, hey, where are you? And if we can find a way to move through these stages of business and get you to a stage 4 or 5, we're going to get more money out of your business. So transition goals, this is a way to go ahead and start moving through those stages of business. So moving to the level that's from a stage 1 to a stage 2, 3, 4, 5, you got to focus on the 5 transition goals. And for us, these are what's listed here are the primary transition goals. So Joe,
now,
why?
Sorry, what, Sean?
I was just going to ask, why does an owner need to focus on increasing enterprise value versus increasing cash flow?
Sure. So often an owner will think that the value of their business is a multiple of their gross, a multiple of their net, a multiple of EBITDA. It depends on the industry. When we're talking about doing this to make your business worth more, it's either because they're going to sell it and they'll get a bigger check, or it's because they'd like to take more time off, not work in the business, but still have it generate cash flow, or because they'd like to transition it to others for ownership or running it and have it stay stable. So net cash flow is what most businesses are built on. A lifestyle business, how much money does it give an owner to spend? How many things spend in the business that are tax deductible, and how much cash comes to an owner? That is different than increasing the business's value, because there are things you would do income tax planning wise, there are things you would do business decision wise to increase more cash flow that may not make it worth more because it's not worth more to somebody else. The third one is helping them see what their transition options are, and then of course alignment with their team or their family. The things in the right and white are things that Founders Group does not do. But if you look in the items of capabilities in the green areas, there's a lot, but there is a lot there for any professional to do. Some of our friends say, Joe, I want to manage the money. Some say, I want to help the owner understand the value of insurance while they own it and in the transition. I want them to understand the value of insurance for the executives to keep them. I want them to understand the value of retirement planning or income tax planning. All of those things are included here, whether it's through alignment or increasing value. Remember, if I have a team that is really in charge of the business, that is more bonded to it, that need to stay, I do better. If I have an asset in the business that's meant for a buy-sell, Shelley, between you and me and our other three partners, and that value of that insurance is there, if one of us dies or becomes disabled and wants to get out, I can also use that value in case the business was going south as an asset. So there are lots of ways in which to adjust.
Now, Joe, another reason to understand your capabilities, which is really what this piece is about. We can talk about process all day long, but typically a business owner comes to you as the advisor, or Joe, you as the attorney, to say, I have a problem, right? I have a thing that needs to be done. They're coming to us for one of these things that you see in white inside the boxes. They're not thinking about the overriding goal. They're thinking about the problem they have. I need to, establish a buy-sell. I need to get my financial statements in order. I need a contingency plan. Whatever it may be, they're coming to you for a thing, and sometimes you have to start with that thing before you try to force them into a whole process like what we're talking about. So there's flexibility here, and the reason that you have these tools that we're sharing today to talk about the capabilities and also the 5 stages of business and a process is because you need to be flexible and take the owner at where they come to you with, and then involve a team to maybe go back and do more of the process.
Shelley, can I interrupt for a second? The thing that I'm hopeful that our participants in this webinar are listening to, they haven't heard a single tax code section, not one. Okay? It's all been conversational. It's almost always where a client walks in the door with a singular problem and walks out with a half a dozen different problems that he didn't even know he had because he didn't think there were solutions. And all of a sudden he has a couple of new friends who have done this hundreds of times before, and this is the first time they've ever done it, and there are issues and there are decisions to be made that now they have coaches and friends helping them through that process. They don't necessarily have to do everything, but at least now they know there's lots of things. But I will tell you that the capability of a communicative law firm and business coaching firm that's the likes of what Joe and Shelley have put together is almost impossible to be able to duplicate, because if you've noticed, most attorneys and most CPAs talk tax code. They don't ask questions. They throw out solutions as opposed to helping clients come to their own self-awareness. And I know full well, because I've been there with these people, is that what you hear the most is, I never realized I could do that. I never realized that was important. Oh, okay, now I have some other decisions to make, but I know I've got some choices, and I know I've got some consultants to help me through that. Is that pretty much on track?
It's very true. It's very true, Simon. And the wild, wild success that our friends have had through the years by walking in with a legal, financial, or tax strategy to a client and saying, I know something you don't know. I can save you with this unique legal, financial, or tax strategy. The wild success our friends have had through the years, that day has long gone. Now, with the advent of the internet, with the advent of everybody else pounding on them, with the advent of social media, etc., there's got to be another way to engage that isn't, oh, I know something you don't know. I will assume, for the purposes of this webinar, that the people on the call have the ability, legal, financial, and tax, to get something to help the client. But it doesn't matter unless you get the client to work with you. So the question then is, how do you cause the client to look over and say, out of the 20 people that have been by me that are trying to get to me to do something, why do I choose you? And hopefully we'll cover a language that has the client say, this is more than a legal, financial, or tax strategy. It's something that will help me that includes some of that. So Shelley, next please.
And I think you made a really good point there, Joe, in that it's about causing them to have a different thought. You know, one of the things that bonds you to your client and helps you build that relationship is to have them think about something in a different way. And so that's part of the goal here. Yes, you want to help them, but you also want to take yourself outside of the box and have them think about you in a different way and have them think about their issues in a different way. So, you know, always you need to have a holistic approach. And you notice down here on this slide in the bottom right hand corner, those are the people that we're partnering with through the Founders Group. So this process that we're going to talk about is built to partner. We've talked about flexibility. We've talked about the idea that the owner can come in at any point, come with financial planning issues, and the advisor notices that there's succession planning that needs to happen, and so now they're looping in and bringing other people in. It's always about a collaborative approach because we can't do this on our own. You guys know that.
And we spend a lot of time talking about an old Johnny Wooden saying, which is there are things you can control and things you can't control. If you become a master at controlling the things that you can control, we call it controlling the controllables, the other stuff will kind of take care of itself. And, you know, every business owner has an attorney. They have an insurance guy. They have somebody who manages their assets under management. They have a CPA. Everyone has that, but nobody knows how to coordinate them into an efficient and effective team. And that's kind of what we're talking about. We're talking about creating significant planning teams, and the people on this call don't have to know everything because we have resources. That's what the resources in the Center for Tax Strategies and Resources involve. And you'll have the ability as members or even as not members to pick up the phone and talk to Shelley or Joe or me, and we can kind of direct you as to what the next step and steps might even be. Would that be correct?
Absolutely.
Oh, gosh, yes.
And you need and what we're about to share in just a few minutes to go through this is you got to start with a process, right? And so choose a process of that collaborative team that you're all using together so that the owner is not in the position of having to manage that process or manage those advisors. So
we're assuming we're assuming that the legal, financial, and tax strategy is there. Whatever it is, you know how to help this client from a dollar perspective, from a life perspective, whatever it is. If the days of selling product and strategy, we are suggesting are less, the method is less lucrative than it used to be. So we're suggesting find out the benefit the owner's looking for and show them a process to get through. And the slide that Shelley had a couple minutes ago showed those 3 steps. This happens to be, thank you, Shell. The next slide, Shell, happens to be the first of those steps. The first of those steps, review and design. Can you, in a review, do a subjective according to the owner, assessment on what they think is good or bad about their business, and then tag a value on it based on that? Could you then, by asking those questions, have the owner say, I now get what I could change to make it worth more? Again, whether you're somebody who wants to help a client through value acceleration, or you want to use this as a lead in order to be the quarterback for the client, and then bring in other people that do this stuff, and you do what you do. So first is a subjective assessment. Second is an independent valuation, not the thumbnail sketch valuation that you might see for a buy-sell agreement or even for a wealth transfer, but one that a valuation that a buyer would do in order to reduce the value, in order to justify reducing the value, identifying those things so you can adjust it with the business owner sooner so their value doesn't get reduced. Gives you a punch list of things to work on.
I was waiting for you to say punch list, right?
Yes.
So that's the whole goal of doing this. We're looking for what the buyer would be looking for. We're trying to prevent those issues to come up later. So we're looking for that punch list. What are the things that we know are going to be the biggest risk items that that owner needs to fix before they try to go to market or even transition? So that's what evaluation does for you. We also have the goal of increasing the enterprise value, right? I mean, that's part of this process. If they're not happy with the valuation, then what are we going to do about it? We're going to identify the things that we can fix, but it's always about increasing the EBITDA and or the multiple. And so that's what this chart is designed to do, is to say, look, if you start out with a current EBITDA of $2 million with a 4 multiple, your current value is $8 million. But look what happens if you can increase the EBITDA by only $1 million and your multiple by 2 to get it to 6. You now have a business that's gone from $2 million to $18 million in net worth. That's just a simple chart that shows how quickly it can work just by increasing one or both of those numbers.
Again, a chart for a client to say, oh, I get it. Sorry, Simon.
Well, that's okay. And in a world of 0.5 or 1% interest rates, if increasing value becomes even more important, reducing taxes becomes even more important, because they're going to have to take the dollars and put them someplace that's going to throw off not only the amount of income that they were taking, but the amount of personal expenses that were being run through their business that they no longer have. And if a recommendation is made to change an investment portfolio or put together a philanthropic strategy or buy an insurance policy, if it's made by the insurance guy, he's the insurance guy. Everybody's got an insurance guy in their hip pocket. Most of them have somebody in their family. If it's made by a counseling attorney who's basically organizing and putting together all of these pieces, you are now part of this team as opposed to a standalone insurance or assets under management guy. It's a very significant intangible piece of the puzzle, and I'm telling you, everybody has the same tangibles. It's the intangibles that make a difference. It's the intangibles that expand the process and the value to the client and the value to you. It's the intangibles. And, we spend a lot of time talking about the fact that there are ways where we can double your income just by giving you an understanding of access to different levels of professionals, some of them standalone, some of them collaborative, such as Joe and Shelley's, but it's a major play to take $250,000 of your current income and turn that into $500,000 with perhaps less stress and time spent than you're doing right now. Sorry to interrupt. Go ahead.
No worries. And those intangibles directly affect that multiple. That's what drives the multiple. So focusing on those intangibles can increase your value by, 2, 3, 4 times.
Sure.
So we've gone through the beginning, right? And we get to the enhancement initiatives. Joseph?
Yes, ma'am. Inside of enhancement initiatives, there are things that a business owner knows intuitively that they need to fix, but they may not have the energy to do it. But there are also things to a business owner that they're blind to that they didn't know that they needed to fix. Inside of those, that's where evaluation comes in. The assessment helps you have the owner say, that's what I should fix. The valuation points out things that a buyer or a lender for the buyer would give a lower value for. And an owner can make choices at that point. Again, whether you're the person that does this work or you're the person that is the quarterback having others do the work, you then get bonded to this client like no one else. And whether they keep the business as a cash flow machine that funds how you help them, or they sell the business and then you have a magical event where you can help them manage the money from then on. It's a matter of helping. Shelley, next. Whether it's as simple as a tactical planning session going through 9 key business questions, find a firm that does this kind of work, if you don't, that has you in the room as an equal partner or maybe even a level above that partner you're working with to help the owner think through these things. A great tactical planning session interacts with the team and the owner. If you're in there facilitating it or helping facilitating, you're bonding to have either a lifelong client if you want it, or a client that will do large planning with you. Instead of low-hanging fruit, it will be engagements one time that are 5 to 10 times higher. Next show. One of the last things that we'll show you before we leave, we do a lot of work in the family business controversy area. So Simon was pointing out earlier today, a lot of families have controversy, frustrations, whether it's within the family or whether it is within the business and the executives, or whether it's how the family interacts with the business with or without family members in it. Most families look for blame then. We would suggest, and this co-platform platform is again a singular image that we set in front of somebody or put up on a screen, and the family member looks over and goes, oh my God. They say, oh my God, we were predetermined for this terrible thing. It's not Johnny's fault. It's not Sue's fault. It's not my fault. We found a problem. We went for help, and we set ourselves up to get in an argument later. We were set up. That damn legal industry set us up. They want to be able to find a solution. You say, you were predisposed to do this. How about if we go back and unpredispose you? How about if we solve for it without blame? So whether you do this kind of work or not, be able to lead with a family, we can help you. Your team, your collaborative team can help realign family members, realign the business, or find harmony, or get out of an argument. They're going to say, please, whatever you can do. Next, please.
Yeah, because they're not going to make any long-term decisions until those issues, those controversies are solved. They're just not.
Very, very much so. I have a client right now, the client I spoke about earlier, that went through a sale, and after splitting with his brother and after taxes, they're looking at hundreds of millions of dollars sitting in a no interest bearing, as he puts it, close to it, bank account, because he wants to solve the family controversy and let the dust settle first. So it's sitting there waiting to be deployed until he can take a breath and decide what to do. He almost canceled the sale of the business because he said, Joe, if we sell it, what are we going to do? I now have a cash cow. I'm going to get a bunch, but what am I going to do? And I got to tell you, Joe, all this money is doing is causing strife in my life. I worked my butt off for all these years. I worked on that floor for 52 years. 52 years of my life I worked there. Now all this, and everybody's going to complain? I know that sounds ridiculous, but it's not uncommon. Helping somebody get unstuck out of the mud, whether they're considering what to do next, they're considering keeping a company, they're considering selling in years, or they're doing it now, being the person where you offer them a place to think and getting them unstuck out of the mud, you'll be that valued advisor. We're now to that decision that they started with. So Shelley, next slide. Next slide here. Shell?
Shell looks like she might be frozen, Joe.
I think she might be frozen. So at least we're not looking up her nostril. So she'll be happy to hear that it's a very nice shot that we've got of you, Shelley, while you're frozen. At that decision time, and Shelley, can you hear us? In that decision time then, the business owner is again saying, do I keep and grow, or do I transition to my family, my team members, or to an outside third party, and do I do it in a whole or part? So today's conversation hopefully has given you language that you can use to attract and engage a client. This presentation assumed that you knew the legal, financial, and tax technical things to do, the legal, financial, and tax technical things to do in order to help the client, but it was the language and tools to attract that client and engage that client that we were talking about today. I look forward to seeing you at the summit together, or the program here in just a little bit. Simon, when is that program?
Well, what Joe's done for us today is a precursor to the Centers Academy that's going to be held on August 17, 18, and 19. These are all Pacific times, from 8 in the morning until 2 in the afternoon. We've got 18 speakers, most of them incredibly high level. We've got 3 attorneys, we've got 2 CPAs, we've got some of the largest assets under management and insurance producers in the country, all helping to try to help you build your business. I mean, one of them is Vince Dodona, who's the all-time leading production leader with Guardian Life. Our speaker next, let me just look at this so I don't make a mistake. Next Tuesday, we've got a tax attorney from Mississippi that's going to be talking about tax reduction plans, which is a means of helping to obviously reduce a business owner's income taxes, therefore increase their budget, make them more comfortable, if nothing else, give you a budget to be able to gather assets, sell insurance, et cetera, et cetera. Our investment, by the way, is nothing to attend these little precursors, but if you wanted to attend the 3-day event, it's $495. It's 3 days of 6 hours a day, or 18 hours. If you take $495 and divide it by 18 hours of coaching, it comes out to $27.50 an hour. Mr. Cesari's hourly rate is about 30 times that amount. There is no way in the world you can match the quality of who we have as speakers, or the value that you're going to get. You don't have to pay for a plane fare. You don't have to pay for a hotel room. You don't have to take time away from your family. So if you're interested in tax savings, you can join us next Tuesday. I'm not sure I have a time. I don't have a time. But it will be one of the better investments that you've ever made of your life, in taxes and in strategy and in relationship building, to help clients do what they would like to do, only they didn't realize they could. I'd like to really thank Shelley and Joe today for taking your time out to help us put this together. I know there's going to be at least 10 times the amount of information at the Academy in general. Joe's going to be doing an hour and 5-minute session for everybody, members and non-members, and then another hour later on as a breakout session for our members. So remember, next Tuesday at 9 o'clock Pacific time, and we hope you have a good rest of your day. Joe, Shelley, appreciate your time. Thanks.
Thank you all very, very much.
Thanks so much.
Bye-bye.
Bye-bye.